Hello and welcome to Informed Investing with HSBC Mutual Fund, partnered by ET Now, where we're in conversation with two distinguished financial experts who bring a wealth of knowledge and experience to the table. And today, they will be sharing their insights, expertise, and strategies in the world of investment. Please welcome Venugopal Mangat, the CIO Equity at HSBC Mutual Fund, and Sriram Ramanathan, the CIO Fixed Income at HSBC Mutual Fund. Gentlemen, welcome to the show, both of you. So without further ado, Venu, let me ask you this. What exactly do you think right now falls in favor of India? And what insights from your global experience do you put to use when it comes to your India investments?
Thank you for having us here. India is actually in a very sweet spot when it comes to the global equity markets. I think India is, as you know, the fastest or one of the fastest growing economies, and that throws up a lot of opportunities to invest. We have a lot of tailwinds that we see for multiple sectors at the moment, whether it is consumption, whether it is infrastructure, whether it is exports. A lot of sectors are today getting a lot of tailwinds either from the demographic profile or from the government incentives or because there is a shift away from other economies to India. Now, HSBC as an organization is very large globally in asset management. We are present in more than 20 locations across the world with more than 600 investment professionals. And we get a lot of benefit from this global parentage in terms of firstly, sharing of research. I think investment research gets shared across the globe. We are all integrated in one platform. All our research goes into that platform. Research from other locations also go into that same platform. So we have access to all the research that is there. In the environment we are today, it is very important to get the global view right because there is a lot of things happening across the world. Even in ESG, I think there is a lot of help and support that we get from the global side.
So Sriram, much like it's difficult for Venu right now because, there are so many moving parts at play. Similar is the situation, I guess, for the fixed income market because, nobody's looked at it since COVID because equity was giving you such a handsome return. But the dynamics within India, especially with the regulations coming in about last year, things are different now. And now with a big question mark about whether it's going to be higher for longer when it comes to interest rates, when are they going to really peak out? What's the fixed income stance?
Sure. No, like you said, I think it's been a fair bit is happening, in fact, on the fixed income space globally. To a large extent, we have been fairly buffered from a lot of it. Our volatility in our bond markets has been very range bound and very less compared to the craziness that we have seen in various developed markets. But I think overall, if you look at purely India from a macroeconomic perspective, I think compared to a lot of the developed markets or to the emerging markets, India actually stands out fairly well. Be it on the external account side in terms of the projected current account deficit, balance of payments. I think the way the fiscal is being handled over here compared to the rest of the world, that's also a huge positive. And I think importantly, the way the central bank and the authorities have really conducted themselves over this time. I think the credibility in terms of the inflation fight, I think is a lot higher over here than in a lot of other markets. I think all of that gives a basic stability to our fixed income market. Yes, from an opportunity perspective, I think finally yields are beginning to rise. I think we are slowly getting into a territory wherein if we see yields go up some more, it starts looking more and more attractive. Finally, from an offshore investor's perspective, I think one of the big changes that you have seen recently is JP Morgan, including the Indian bond markets in the GBI EM index, right? And I think that underscores the global investors' need for having a market like India in an EM index. And I think with $20-25 billion likely to come in over the next between June and March of 24-25, I think it's a huge positive tailwind for our markets. Of course, the fight against inflation continues. So we are going to probably deal with rates remaining elevated. But if you'd ask me over the next couple of years, I think we are pretty much from that perspective, we are close to the peak of interest rates now.
Venu, would you like to add to that? Because Sriram clearly has put the bull case forward for fixed income investment. When it comes to equity markets, like you earlier as well was alluding, I mean, it's kind of obvious that India is the choice, but valuations are not really all that comfortable as they were even a year back.
Absolutely. I think markets have scaled up quite fast and in a short period of time, and hence valuations are looking a little stretched. Even though I wouldn't I wouldn't go to the extent of saying they are very expensive and out of range. We are slightly above the long period average at this point in time. The good thing is that there is earnings growth that is playing out. The expectation for the next 2 years is far better than the last several years we've seen in terms of earnings growth for the Nifty. And to that extent, I think if you keep the index at the same level, over the next 1 year, you will see the valuations drop quite meaningfully. Equity markets also expecting interest rates to correct at some point. Maybe that has got delayed and pushed back a little. But the expectation is good enough that maybe in a year and a half, interest rates will start coming down. Inflation is anyway down within reasonable levels, I would say, and therefore the markets are quite hopeful. And to that extent, I believe the markets will continue on the positive direction with corrections in between.
But that brings me to my next question, because if you keep few sectors out, maybe like an IT, maybe not all the board pharma, but rest of the market, and especially the length and breadth of the market, it's all performed really well in the run-up to the recent highs that we had about a month and a half back. How is it that you at HSBC try and tailor the equity market preferences to suit each and every individual investor to make them get the maximum out of equity returns in a market which is very well discovered?
Yes, I think we have seen participation across multiple sectors, and like you rightly said, valuations have moved up across the breadth of the market to a large extent. But having said that, I think the growth environment is fairly strong, and which is the reason, to my mind, the broad market is really doing well at this point. The risk appetite is fairly strong. There is a fair amount of liquidity in the markets. There is expectation of better growth coming. There's an expectation of interest rates being cut at some point. All of this is actually feeding into the rally in the broad markets. When it comes to HSBC and the products that we have, I think we have a full suite of products ranging from the arbitrage fund to the small cap and the thematics. So, which is covering the entire risk return spectrum, and depending on the investor's interest, his risk appetite, age, and the rest of what we generally look at, he can come into any of these products. We also have thematics which are catering to some of the sectors that are or some of the themes that are playing out at the moment, including the investment theme, which is there, and we have a product on the economic cycle as well. So we have the entire range of products from where the investor can choose from.
Sure. Sriram, is there an overarching theme that you have at HSBC to try and guide and get the investor the best out of both equity as well as the debt market?
I think clearly the hybrid or the asset allocation funds are very much there. So we have various versions of it, whether it's aggressive hybrid, the conservative hybrid, the balanced advantage fund. So I think within that, clearly, I think the way things are panning out, there is an increasing need for these kind of funds as well in terms of asset allocation perspective, and especially in the context of fixed income, maybe over the next year, 2 years becoming, let's say, somewhat more attractive. I think increasingly the need for having some allocations to fixed income is there. Now, whether one achieves it to these kind of hybrid funds or whether individually into different fund categories, I think that's a choice for the advisor and for the investor to make. But you're absolutely right. I think the providing options to investors is what we can do. And I think slowly the industry is having enough various options, whether it's a 65-35, 50-50, 35-65 the other way in terms of debt and equity. And I think it's a choice for the investor to make in terms of whether going for a consolidated fund which does both the things, or really choose, like Venu mentioned, various categories that are available on pure equities, and at the same time you have similar options available on the fixed income side as well, and do the asset allocation at the investor's end itself. So
Venu, but there's got to be some overarching investment philosophy, right, that guides the management per se, because what differentiates one mutual fund than the other?
Yes, so the investment philosophy and approach will differ from equity to fixed
Of
income.
course, yes.
On the equity side, we are fundamental based investors. We keep the investment approach fairly simple. We like companies, or we invest in companies which, or businesses which are strong, which can grow, which have a long runway of growth, run by good professionals who have the drive and the energy to take the company or the business forward. And which are available at reasonable valuation. So we look for companies generally, in general, we look for companies which can grow and which are at reasonable valuation. So we are growth at reasonable price investors. We are extremely bottom up in our approach to investing, so which means that every stock will come into the portfolio based on its individual merit and not based on a sector or a top-down view that we have. Of course, we have some schemes where you need to have a top-down view as well. Which is, for example, like the thematics. But apart from that, in general, we are bottom-up investors. We do take bets outside the index. We are not averse to taking that, and therefore we are active investors. We strongly believe that alpha generation is possible only by going outside the index and identifying companies early and staying invested for a long period of time for that value to get unlocked. We are also long-term investors, so we don't churn our portfolios very frequently. We are true to label investors, so we believe in the mandate that we have been given by the investors, and we stick to that irrespective of how markets are behaving. So it's very unique when it comes to the investment philosophy for equities, and I think.
Yeah, and I think just to add to what Vinu was saying, I think one of the key things that I think that HSBC brings is, I think over time there are not too many globally large asset managers who are still here. And in terms of, let's say, a combination of scale domestically and the kind of reach and expertise that we have globally, I think it's that we would want to really bring across to the investors, whether it's in terms of product innovation, whether it's in terms of investment philosophy and processes. And I think most importantly, in terms of access to this whole network of analysts, portfolio managers globally, which is becoming more and more relevant. So I think that's I think one of the key things that, be it even in a developing area like, let's say, ESG, globally HSBC is right at the forefront. They've been involved with the way markets have shaped. So as things evolve over here and we are at a nascent stage of, let's say, market development, I think it would be fantastic in terms of HSBC bringing some of that global expertise and really helping shape the way things develop over here.
Sure. That's the other thing, Venu, because being ethically conscious is sort of now really ingrained, especially in the newer investors who are coming into the markets, right? How do you incorporate ESG principles into your mutual fund schemes?
So ESG is a part of the investment process. So it's part of the culture. So when we analyze a company, we do our due diligence. We look at all the parameters when it comes to ESG. We engage with the company on a regular basis. Even post the initial analysis and due diligence, we on a regular basis engage with these companies. In this regard, we take the help and support of the large global team as well within HSBC, who is practicing ESG, who is very much into sustainable investing and has been in, it's been a focus area for HSBC for I think more than 15 or 17 years now. So it is an important part of our overall investment process itself. It's well ingrained in the investment process.
Right. Hold on to that thought. We'll pause here for a short break. When we return, we'll pick up our discussion with Venugopal Mangat and Sriram Ramanathan from HSBC Mutual Fund. Welcome back to Informed Investing with HSBC Mutual Fund, partnered by ET Now. Let's continue our conversation with Sriram and Venugopal. Sriram, traditionally there was only one fixed income route, right? And that was fixed deposits. But now there are so many ways to invest into the debt markets and fixed income per se. What advice would you give to investors, new investors who are now looking at fixed income along with equities, but fixed income, let's address that first, who are coming into the market and who have a medium to long-term horizon? What is it they should be doing first?
Sure. I think one of the important messages to really give to new investors is that our markets have evolved a lot over the last, especially last 7-8 years on the fixed income, let's say the mutual fund space, and also the broader fixed income markets. We have gone through a lot of has been learnt. Importantly, a lot has been put into effect by the regulators. So I think one of the key things is this whole fairly clear-cut categories of various funds, the do's and don'ts within each that. What that really helps ensure is for a new investor coming in, I think the scheme category, what it can do and what it cannot do, itself gives a lot of comfort, should give a lot of comfort to the investors of believing that money is being managed in an effective way. So I think that's one of the key things that has happened over time. The other thing is the spread of products, and that's where I think it is important for an investor to realize the investment time horizon that they are looking at. But at the same time, there are a lot of funds on the fixed income side now, which over time do lead to a higher risk, higher return kind of a payoff. And yes, there is an opportunity from time to time that comes into play. But I think those are gradually, once an investor has gone through the, let's say, the shorter end funds and has got familiar with what fixed income really is, there is a little bit of volatility. It's not similar to an FD where it's just steady accruals. There is market risk involved. And I think that's really the journey that we have to, as mutual fund industry, we have to really encourage. And I think that's one of the key things for overall at an industry level as well.
Right. Venu, much like fixed income, equity markets also have evolved from where to where, and, in just the last 3 years, right? From Robinhood traders now to serious investors. Every now and then market gives that shake off for weaker hands to get off and, newer ones to come in. What do you think is the medium term outlook, and what is your own message for new investors who are coming into equity markets for the first time? What's the advice out there?
Yeah, I think you're right. I think there has been a large number of investors who have come into this market over the last 2 or 3 years. I think post-COVID, the numbers have just gone up at a staggering pace. Part of it, to my mind, is to do with the technology shifts that have taken place. It's far easier to trade and on your mobile phones, etc. So that, I think, has helped a lot of investors get into the markets. Of course, the market's also evolving, and the education levels or the knowledge about markets is getting better. And to that extent, I think this is a structural change that is taking place. However, the point I would want to convey to investors is that it's not very easy to make money like this. I mean, the last 2 years where or post-COVID, the rally that we saw was a
Black swan event,
one-off kind
and
of,
hopefully
yes,
it doesn't
absolutely.
repeat itself.
You don't get those kind of rallies on a regular basis, and one needs to be careful. One needs to be aware of the risks that are there in the markets and stay away from short-term trading ideas and tips that keep coming. The good thing is that the economy is likely to do well, and therefore the markets also should reflect that. But you will have these intermittent ups and downs, and for serious investors, I think these should be taken as opportunities to invest. And I do believe that there may be corrections at different points in time. Those corrections should be taken as opportunities, and the longer you can remain invested, the more patient you can be. It's better for investors to generate wealth.
Yeah, don't try and time the market.
Absolutely.
It's timing in the market
Yes.
that really counts. Venu, what we've seen of late, at least in the equity markets, is that it's the domestic institutional investors which are really doing it all alone. Even in the run-up to the recent all-time peak, it was the DII participation, not as much FIIs. Just wanted to understand, how is it that the international investors are viewing India equities per se right now?
I think the international equity investors are very, very positive on India, and we've had roadshows outside India recently. We've had calls and multiple discussions with entities outside, including within the HSBC system. The interest is very, very significant. Most investors are very clear that India is at that inflection point or close to that, where you get that strong growth over maybe a decade or so. And everybody wants to participate in this. Of course, there are question marks on valuations, and having seen the markets run up so sharply, what do we do now? Currency moves, all of that will be in the background. But I think serious investors are looking at India in a very favorable way. They are increasing their exposures as and when they get the chance to invest. I think the serious investors are very, very focused on India. They clearly believe that India is the next investment destination. And you're seeing the numbers and the data coming out from the economy, and that's enough proof for them to really take this forward. So we believe that over the medium to long term, there will be significant flows back into India in terms of foreign institutions.
Sure. Sriram, unlike Venu, where there are all green flags for equity markets, that India is the bear, there are too many moving parts when it comes to what's going to happen to fixed income. How do you think global investors are viewing India as a fixed income destination?
Sure. I think the way to look at India is more like a medium to long-term asset allocation play from an international investor's perspective, not really to time it into a very short horizon and try to make money. And which is where a 10% weightage, for example, in that index, which brings in $25 billion, that's going to be the core of it. Beyond that, of course, investors may choose to go overweight, underweight, etc. But that's really a core part of the money. I think this is just a start. I think once the flows start coming from, let's say Jan, Feb, March onwards into our markets, and maybe some of the other index providers also start including India, I think we'll see India becoming a little bit more of a mainstay in terms of global bond investors as concerned. So it looks fairly good from a medium-term perspective.
But again, it's not timing the market, but timing the markets. A stretcher time horizon, even if you're looking at these products.
Yes, to a large extent, absolutely. But having said that, I think while the volatility out there in the rest of the fixed income market has been very high, there are reasons why our volatility is lower, right? So that's also another thing that even from an investor's view over the next year, 2 years are concerned. The fact is over here, core inflation is actually on a nice declining trend. Yes, we do have our foot spikes in terms of inflation. The trend on inflation is fairly good. Monetary policy credibility is very high. Central bank is doing a fantastic job of managing various things on the currency, on the bond markets. So I think those things still keep India in a fairly positive light, and which is why I think a lot of international investors wouldn't mind exposure to Indian markets irrespective of the timing aspect of it.
Well, that was great insight, both of you. That's all the time we have with Venugopal and Sriram on this episode of Informed Investing with HSBC Mutual Fund, partnered by ET Now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.